The strategy Suze Orman teaches, not necessarily lives by, is dangerous, detrimental, and can leave you trapped in a financial prison. Yeah, actually can. Suze Orman heralds compound interest as this ingeniously wonderful thing. And many just accept that in some sort of money-making miracle. But today, I'm here to kill this dangerous investment strategy and save you both time and money through a faster, safer, alternative way to wealth. Look, if you've heard this story, I've heard it over and over because sometimes when I talk about this, people are like, but Albert Einstein, one of the most intelligent human beings, made a huge difference in the world. He talked about how there's a miracle of compound interest. Well, I decided just to do a little bit of research. And what we found out is he had a conference in Austria where he talked about compounding numbers. Then in 1927, Security National Life talked about the miracle of compound interest by misquoting Einstein, which that's never happened on Facebook. That never happens, right? It's like he's one of the most misquoted people. And so compounding numbers and compounding interest are very different things. Yes, they have some similarities in that compound interest, your numbers will compound over time using that principle, but the reality is you have to wait for a certain period of time. There's a time piece and component to it that we weren't looking at before. So let me break this down into 3 reasons why compound interest and this Suze Orman strategy is absolutely dangerous for you. The first one is it absolutely neglects cash flow. So it neglects cash flow in a few ways. The most guaranteed return most people can get is paying off high interest rates. Now, Suze may agree with me on that, and typically we'll talk about that. But a lot of times she'll tell people not to buy things and instead compound that interest in a fund because that interest is going to earn 10 to 12% because that's what the market's done since 2000 BC. Well, the reality is it hasn't because it doesn't take into account all the fees that are associated and the volatility that's associated. So let me give you a volatility study here. Okay, this is just using simple mathematics and showing how math and money are not always the same thing. I discuss this in my book, Killing Sacred Cows. So if you had $1,000 and you invest it and you earn 100%, it grows to $2,000. That's awesome. But if the next year you lose 50%, you're back to $1,000. Not so cool. That's if you paid no fees and no taxes too. So your actual return in that point is 0%. But the average return, if we use math, is 100 minus 50 is a positive 50. And if we're getting the average, we divide it by the number of years. So the 2 years is a 25% average. 100 positive minus 50 divided by 2 is a 25% average, even though the actual return was 0. Let me make it even more simple. If you lose 10% on your $1,000, you're now down to $900. Now, if the market gains 10% the next year, you're not back to $1,000, you have 10%. It looks like the market recovered, but you're actually at $990. You still have a loss because you only earned 10% on a smaller number. So we want to look at the reality here. And if instead of trying to think that you're going to get 10 to 12%, which is a pipe dream, and people like Warren Buffett says expect more like 6 to 7%. And when we look at everything that's happening with technology, with a higher rate of companies going out of business and falling off, the S&P 500, these mutual funds are not reporting accurately what's going on because a company can go out of business, they replace it with a new company. You actually lost money, but now they're showing your average return based upon the new company that went in and replaced. Now, if that's making your head spin, the bottom line is, do you trust Wall Street? Do you think they have your best interest in mind? Do you think just setting your money aside in this has been really the best thing for you? If you haven't focused on your cash flow first, it's dangerous. Pay off high interest rate loans. Save on taxes so that you can improve your cash flow and keep more of what you make. Restructure the loans that you have so you're paying less interest by improving your credit score. Find out if you have duplicate coverages or improper structure with your insurances and change your deductibles or the types of insurances you have so that you keep a lot more of that money. Right? And then focus on ways that you could increase your cash flow by earning more money. What can you do to become more passive investing, right? Where you're still involved, but you get cash flow on a regular basis. Waiting for 30 years is just far too long. And that compound interest has us neglect that cash flow, neglect responsibility, trust way too much into Wall Street, and then when you get there, you find out it didn't work out. And that's happened for far too many people. So what's another piece? Another piece is investing in the stock market usually has people believe that they've got to take high risk to get a high return. But the reality is risk equals your chance of loss. High risk doesn't equal a high return. Instead, it equals a higher chance that people end up losing money along the way, getting bitter and frustrated, not trusting the market, finding out it's going to take longer that they have to work or they have to invest even more money into it, but they've lost the time value of money, because most financial people will tell you, if you just start early enough, it's all going to work out and you can put a lot less money in if you start early enough. We see all sorts of authors out there talking about that, but I'm looking at the real world. I'm looking at what's actually going on. So what can you do instead? Invest in yourself so you can lower your risk. Find ways that you can protect your downside. Don't just hand your money over to other people. Start looking at the companies you're investing in. Do you understand what's going on with those companies? Why you would invest there? And it doesn't just have to be stocks. What other types of investments make sense for you? So this goes, once again, to being more efficient. There's 3 ways to live within your means. And the first way is to budget, which a lot of people are taught. Budget, that's what Suze loves to talk about, and put the money in the market. So here you're being ultra conservative, cutting expenses, and then handing your money over to companies you don't know or understand with the wolves of Wall Street. Well, the second thing is you could be more efficient. There's 4 I's to efficiency. Save from the IRS. Save money from interest. Save money from investment fees that are hidden or that are non-performing, or save money on insurance. That means that you keep a lot more of what you make. Or the third way to live within your means is to expand your means, which is invest in yourself. Find ways you can create more cash flow, that you can make more money. In my book, 5-Day Weekend, we begin by saying, hey, how do you make more money? That's going to have a huge impact on your life. Whether it's being an entrepreneur and contributing more to the bottom line, but getting upside potential, figuring out how you can have a side hustle, or being a business owner, investing back in that business to improve cash flow. These are just a few examples. Then you keep more of that money you make, so that you're not just handing it over to the government and to institutions like insurance companies and investment companies. And then from there, it's really about learning to be a better investor. Don't skip over making more money first or keeping more of what you make. Some people just try to be an investor and they're more of a gambler. They're more of a speculator. They're just handing their money over because they thought high risk equals high return. But the biggest institutions don't take a risk. They get you to take the risk for them. Let's learn how to rig the game in your favor, legally and ethically. So in this video, we're just covering 3 reasons why compound interest, well, it's misleading, and frankly, it kind of sucks. So I wrote a Forbes article. For a more detailed look, you can go into 5 main reasons compound interest is like the biggest roadblock to financial freedom. So you can click on that link, you can check that out, but let me give you one more here. The third one is that compound interest can actually create compound tax and compound cost. So think about it, if interest compounds, it's like the first 10 years it doesn't look great, the next 10 years does better, but that last 10 years is that hockey stick, the exponential growth curve. If you've seen mountain charts or compound interest charts, well, if we just add in the tax destroys a lot of that, slows it down because it's less money that gets reinvested. The same thing happens with fees. If you have these fees in there, that starts to slow that down exponentially because it takes so much longer to double. So here's a very simple example. There's something called the Rule of 72. The Rule of 72 says you take whatever your interest rate is and you divide it into 72, and it tells you how long it takes for that money to double. So if you're getting 1%, it's going to take you 72 years to have that money double because of compounding interest, right? But on the other hand, if we're getting 10%, it only takes 7.2 years for that money to double. Now, if we run any of the different numbers, so look at your fees, like take that percentage, divide it into 72, and then go, what if there's fees, what if there's taxes? Take the net amount, what amount after taxes and fees, and run it through there, and all of a sudden you're gonna see your numbers are drastically different. It takes so much longer, it's exponential. So that's my tip. That's like a really nice thing, the Rule of 72, to figure this out. So instead of just compounding the tax, you could put it in more tax-free environments, right? Some people put that into tax-deferred environments like retirement plans, but a lot of retirement plans are riddled with fees, and they're also something you're gonna pay tax on the way out, so it's very important to figure out how to get that money out tax-free. Some people then move more to a Roth IRA, so the growth inside of there doesn't have tax against it, and under the right conditions, they can pull that money out tax-free. That might be an improvement. I don't love giving my money to the government and hoping that they're not, inside of their plans, and they're not gonna change the rules in the future, because we're already seeing they're changing the rules right now. They're changing rules inside of these plans as we speak, depending on if it gets signed off, and that could have a negative and adverse impact on you. So instead of just putting it into something that's more 401k, 403b, IRA, or those kind of tax codes. Look for more private strategies that could create tax efficiency, but most importantly, look at your own tax efficiency. For me, I like to use cashflowbanking.com because it's more of a private contract. Could they change the rules? Yes, it's just that it's harder to change than just a swipe of a pen like they do with retirement plans. So the strategy Suze Orman teaches is dangerous and detrimental, and it can leave you trapped in a financial prison. It's not like what she's doing with her own money. There was a study and they exposed where she actually had her money not that long ago. There wasn't that much money in the stock market, so it wasn't all about compound interest. It was really about her growing her business, growing her brand, being more of a thought leader. So what is it for you that's part of your plan? Where can you invest your money? What can you be investing in? Stop just handing it over, stop just hoping for the best and end up seeing that it didn't end up turning out how it was supposed to, because you can be in control of your money. You can invest in what you know, and you can transform your thoughts into profits while actually building the life that you love. If you're looking for more on this topic, check out this video about the secret strategy Wall Street doesn't want you to know. I'll see you there. 80% of all investments out there have a negative return. If you're investing in something you don't understand, you're just throwing money away. It's time to make money on the buy.